Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mike.
JC, thanks for having me.
Yeah, man. What's going on, my man?
Not too much. Enjoying the show.
Appreciate it. All right, let's get right into it. What's on your mind? What are you thinking about? It's what day is it today? Today's Wednesday. Holiday weekend's over. Just getting going in the summer. When you're talking markets, informally, let's say we're at a bar or something, having a beer, and the market, I was like, oh, how'd the market close today? What kind of conversation are we having? What are we talking about?
Well, I hate to repeat what you guys were just talking about, but I think everyone's looking at that 4,200 level on the S&P. And I think that sometimes it's boring when you just talk about the S&P 500 over and over again, but there's no doubt that's the level in focus.
So you think that it's the levels in the S&P 500 specifically, not so much the components and what they're doing? You're focused more on a specific level?
I think it's both. I think that most of the questions that I'm getting right now are disproportionately focused on the S&P.
And it's underperformance compared to the NASDAQ, or more so on an absolute basis?
Well, I just think everyone looks at the S&P and that's the market. And so people are wondering whether this is the beginning of a new bull market. And when they talk about bull markets, they're usually talking about bull markets in the S&P 500. I think
they're not talking about Denmark?
No, usually not. Well, that to your point, I know you've been talking a lot about developed markets abroad. And that's clearly been a much better place to keep your money than the S&P 500 recently. We're US focused at Invictus. So we're probably more focused on the S&P. Of course, the NASDAQ and NVIDIA and the big tech names that have been driving the Qs and the S&P are also a topic of conversation. It's really funny when the big names are performing well, everyone loses sight of the other, 3,000 tradable stocks in the US.
It's really amazing because when they're talking about the market, they're talking about the S&P. They're definitely not talking about the Russell 2000 either, right?
Right. Well, Stan Druckenmiller talks about the market internals. He says the best economist I know is the market internals. And when I look at the market internals, what I see is not particularly bullish.
Yeah.
Right. Small caps right at that 2018 high, right, where growth and inflation peaked last cycle. That's kind of an important level across assets. You've seen crude oil break down below that level. Crude's a really important asset. I have a hard time imagining a breakdown in crude as bullish for any of those other assets that are right at that level. So small caps, transports, financials. I'm giving away my bias a little bit here, but I think that crude is probably the leading indicator for this cycle. I think that's probably the first asset to break that level, and I think that there's probably quite a few more breakdowns to come.
What's driving the weakness this week, you think, or even today? Is it just this China factory data?
I haven't looked at the market yet today. I'd have to pull it up. What are you saying?
Crude's weak today, and I think there were some China numbers out this morning.
Yeah, I believe that makes sense. I think that there are a lot of headwinds to the market right now, and there have been. So first of all, economic growth has been slowing. That's one of the since 2021, really. Yeah. Since Q1 of 2021. And I'm sure I don't need to tell you guys that a lot of important risk exposures sort of peaked in either absolute terms or in relative terms in Q1 of 2021. But growth is slowing from a very high level, right? Because it was the reopening reflation. And so it's taken the market a long time for that to sort of digest through to the headline indexes like the S&P 500. So, global growth slowing is a headwind for pretty much everything right now. Since October, we've seen some sort of central bank liquidity tailwinds.
Yeah.
The Treasury Gen, you guys probably don't care quite as much about this, but the Treasury General account drawing down puts downward pressure on rates. The expansion of the Fed's balance sheet in response to the regional banking crisis in March also puts downward pressure on rates. And a lot of that stuff is sort of resolving now. Mm-hmm. And as that resolves, it puts upward pressure on rates and downward pressure on long duration assets. Obviously, the Qs haven't heard about this yet.
I want to throw up this chart quick. Throw up slide 2. Throw up slide 2 there.
Hold on, JC. That's a great point, Mike. We're looking at these tech stocks and these growth stocks with rates doing what they have over the past few weeks and saying, who's right here? What do you make of that? Because they've been moving in opposite directions, right?
Ultimately, I think yields are going to be right. Rates are going to be right.
Okay.
That said, this is probably the worst, most boring answer about the Qs and what's going on with big tech right now. there's really no fundamental explanation that I can think of for why they're doing so well, right? Like I track the liquidity data and the economic data, and neither of those two drivers are adequate to explain what's going on right now. So I think all I can think of right now is sort of hype around AI.
Well,
and
hold on. Aren't forecasted future earnings far higher this week than they were just last week? Doesn't that explain it?
Maybe. I think if you look at the trend in earnings revisions and earnings surprises, though, over time it tends to track the growth cycle. And if you look at when it peaked out in 2021. So like, have there been some marginal upside surprises since February or something like that? Sure, but they're not. I wouldn't be.
We're calling Nvidia marginal.
I think
that was a big individual beat. But if you look at the aggregate revision indexes, they've been rolling over for a while.
What do you think about this chart right here with interest rates and crude oil futures? They've been, in sync for quite some time. The 10-year yield's been consolidating sort of sideways above those former highs, and crude oil is not. To your earlier point, you said before that you think that the rates have it right. The bond market has it right. So
crude oil has it more right. I think that crude oil is a reflection of a very weak underlying global economy, and the 10-year right now, this turn up is a function of sort of technical dynamics that aren't going to drive a longer term trend. I think what would drive the 10-year higher is if there's no recession and the Fed continues to hike rates, and crude oil is saying, look, that's not going to happen, right? Crude oil is down like some 45% from its peak. Why might that happen? There's really only two explanations. There's only two things that drive the price of crude. There's supply and there's demand. Right. And I think pretty much everyone knows that there's not a ton of new supply coming online, which suggests that crude oil is down because global demand is slow. And when global demand is slow, that generally precedes lower rates.
And what about copper? Throw up the next chart there, Spencer, on same thing here, slide 2. Same thing. What are you thinking there with copper? I mean, we're hitting literally down to the lows of the year, right, in copper.
Yeah, I think it goes down to 330 or even 315. I think you had a great short opportunity at 415 or 420, right? But look, as Dr. Copper, right? Why does he have a doctorate in economics? Well, because he tends to trade on the growth cycle, just like crude does.
Oh, is copper a he now? We're using these pronouns for copper.
Well, what do you think copper should be?
I think copper's more of an it, than a he. No. I mean, listen, for me, it's very simple. Look at that former support, right? Look at that former support from 2021, early 2022, and that turned into resistance, right? You nailed it, that 415.
So
right. I mean, it's kind of in the middle of a range right now. So tactically, I don't know if I would be getting all in on shorting copper, but I think I'd be looking for opportunities to short as they arise.
So what do you? Sorry, Strazza. Strazza hates it when I steal all the questions.
He doesn't shut up. So we have. Let's play devil's advocate. We have things like copper, transports, railroads, right? Mm-hmm. Really pro-cyclical groups that we want to be seeing do well for risk appetite purposes, trending very poorly. But I can also point out to you semiconductors and home builders and other very pro-cyclical risk-on groups that are trending great right now. So how do you weigh them all?
I love that you just went like this, because who does
that remind you of, Mike?
It's got to be Frank Teixeira, right?
Yep.
So I think that whenever you're evaluating the markets and the economy, you're always trying to use a weight of the evidence approach. And no matter what part of the cycle that you're in, you're always going to find some counter evidence to whatever your thesis is. Yes. And look, there's no doubt that semiconductors and home builders are outperforming, and they have been for a while. And that's counter evidence to the economic environment that I'm describing right now. So I think that their performance is very hard to explain, and I think it's inconsistent with the weight of the evidence. But look, it is what it is. And as thinking about this from the perspective of an investor or even a technician, I don't mind having positions in some of those stocks if the risk reward is very good. I wouldn't be sizing up these positions hugely, but when something is going right and you can't explain why, I think that sometimes that's an argument for having a little bit of exposure there.
Yeah.
To that point, what we're talking about this whole thing, for those who are unaware, Frank Teixeira, great technician, legend, the way he says it, he said, on one hand, you've got this and this and that. And on the other hand, you've got this and that and that. And whichever one weighs more, we want to kind of lean in that direction. And then at the CMT symposium about a month ago, Gina Martin Adams from Bloomberg, she was at Wells Fargo for a long time at Bloomberg, was basically saying the exact same thing. You know, she was up on a panel and she's like, you know, we're seeing home construction, we're seeing semiconductors. This is before the semi squeeze over the last couple of weeks. We were already seeing strength in semiconductors, and home building and some of the other areas, you know, are showing strength. Then you got the financials and some of these industrials that are struggling. So, you know, really getting mixed signals there. So that seems to be, and I like your point, you know, if the opportunity's there, despite any mixed signals, take the opportunity, right? Maybe don't overthink the intermarket analysis in this environment.
A lot of times we don't find out why until later, I think is what you're saying, right, Mike?
Right. Or maybe the later is unknowable. And I think that this is also brings up one of the great benefits of technical analysis as a discipline can bring to anyone's investment strategy is no one's better at managing risk than technicians, right? So if you see a good risk reward setup, you can take it and you're not going to get your head ripped off if things go wrong, right?
But that's what I like about the Caterpillar trade that we just put on over the last couple of weeks. That's what I like about the small cap trade that we put on over the last couple of weeks. Yeah. We're betting on that rotation. But if the rotation doesn't come, we're going to know right away. We're going to know very soon.
That's exactly right. Now, I think everyone could take that, and whether you're a technician or not, everyone could take that that understanding of risk, and it would benefit anyone's process.
So what's nobody talking about? Because you're talking about, oh, I don't want to repeat what you guys just said. Oh, everyone's asking about the S&P 500. What are people not asking about?
Give us your hottest take.
Hottest take. It really depends. It depends on who I'm talking to, because I talk with some technicians and the technicians are looking at certain things. And then I talk with a lot of fundamental analysts and they're looking at other things.
I want to know what you think. Forget who you're talking to. I want to know what's on your mind. What are people not talking about?
Okay, so here's my most contrarian take, and it's a longer term perspective. So if you don't like it, you can just dismiss it as long term. Right now, everyone's talking about, or like a lot of analysts have been talking about sentiment, right? And everyone's bearish, and this is the most forecasted recession of all time. At Invictus, when I do my work and I go through all the numbers and I look at sentiment data, not very much of it is useful, and most of it tends to track price. And so I think when you're talking about the AAII data or the investors intelligence data, you might as well be looking at a momentum oscillator. I don't know that there's any real value add in looking at those things.
The NAAIM one looks just like the growth chart.
Right. Yeah, exactly. So I tend not to spend as much time on the sentiment data. I don't give that a lot of weight. I like to look at positioning data, and even within positioning data, not everything has the same amount of signal. So a lot of people look at the commitment of traders data. I've yet to see any really persuasive analysis on that. I think it's good to know, but it's not something that I would take a big risk based on.
But do you think these hedge funds that are the most short ever on the S&P futures, you think that, the argument is that they're hedging their long positions? You buy that?
I don't know. I mean, the futures only compose one part of the market. So I don't know if that's a reflection of other dynamics taking place elsewhere that I can't see.
So for example, if we had such extreme positioning in something like cocoa or sugar or a more pure futures market, you take that more seriously than something like the S&P futures, where there's so many different ways to get exposure to the stock market, not just those futures contracts. Is that what you mean?
That would be very logical to me. Yeah, it would. But I'll say I don't spend quite as much time on cocoa futures, but mostly because my clients aren't quite as into it. What I'll wrap up by saying is one of the best positioning measures that I like is the Fed flow of funds data on household equity ownership as a percent of financial assets. And the reason that I care about that is because it has a very close correlation with 10-year forward returns. And right now, positioning is 95th percentile according to that measure. So people have only owned more stocks as a percentage of their financial assets 5% of the time. And so what that implies is real annualized returns over the next 10 years of, call it, between 2 and 3%. So I hate to end on such a negative note, but that's something that I don't hear anyone talking about.
Negative for who? Who cares? If people didn't like it, they can shove it. I respect that. I like that.
JC, you're in that boat,
In which boat?
The people that own financial assets.
Yeah, but I have the ability to short them. I don't care about what other people do and what bags they get left holding. That's their problem.
Okay.
JC is good at changing his mind.
Yeah. All right. Mike Singleton, senior analyst at Invictus Research. Mike, thanks for joining us as always.
Thanks, Mike. Come back soon.
Thanks for having me.
I can't take no loss. I don't even know what it costs.